Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Phil Mackintosh, Chief Economist at Nasdaq, to discuss if the sell-off is really that bad for stocks. And if you're looking at it from the perspective of the first half of 2022, certainly feels like it could be, but if you look over the past week, it's really back to earnings and really back to the Fed.
And I think that's the point, right?
Right.
So it's one of the worst starts to the year that we've ever seen. But the last couple of weeks, we've sort of seen the market stabilize a little bit. And the sell-offs this week have been mostly due to news, which has been some poor earnings on the tech stocks, on retail, and then obviously the housing data a couple of days ago as well.
Well, let's talk about the housing data. It really does come back to supply and demand at the end of the day. And we keep hearing, oh, this feels like 2008, 2009, getting comparisons to 99, early 2000. Is the housing crisis anything relevant to what we saw in 2008?
So I think it's quite different. So one of the things you can see with housing, obviously interest rates are going up, prices are going up. That means the cost of a mortgage is going up. But there's also a shortage of housing. So part of the reason that the house prices haven't come down, even though interest rates are going up, is just because there's no inventory for people to actually buy if they want to move into a house. But what we are seeing is mortgage applications. A lot of the housing starts data has been slowing for months. And so the data that came out this week was actually kind of negative, and it showed that slowdown has increased and it's continuing. So the final shoe to drop, if you like, is going to be the house prices. And with mortgages almost 50% higher than they were 6 months ago, people are obviously looking twice at whether they want to buy a new house or go to Home Depot and do some renovations.
Well, I mean, imagine being a mortgage broker right now. No new mortgages, no one refinancing. I mean, I would imagine that it's pretty dried up, that business as it stands right now. So I guess the question is just how bad is this sell-off?
Yeah, I mean, in reality, we've had a pretty bad start to the year. If you look at how much we're down compared to previous recessions or even like rate hike type sell-offs, we're in the middle of some of the mild recessions. So we've priced in a lot of bad news is kind of the short answer. When you look at the market pricing in a lot of bad news, typically 6 to 12 months later, you actually get a bounce. So more often than not, the markets price in all the bad news, realize it's not quite as bad, and later on the markets are starting to recover. So let's hope we see inflation start to come down a little bit. Interest rates have actually started to come down already, so maybe people think that inflation will get under control with what the Fed's already planning, and we'll start to reassess how bad the recession risk really is.
Well, I mean, when you think about a recession, you don't even really know you're in it until the data comes out. So we had one bad quarter for GDP. We really won't know if we're in one or not because it's 2 quarters of bad GDP prints to determine if you're in a recession or not. We could be in one.
Yeah, although in reality, there's so much strength in the economy, and there's still 2 jobs for every 1 person looking for a job. There's still a lot of savings in people's bank accounts. Retail spending is still really strong, and the GDP on average is running at about 3-4%. So it's got to slow down a lot before it's what you would call a recession.
Right. All right, Phil, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.